Today I'll be pitching an idea for an E&P company called WPX Energy. Drivers in the E&P industry include the world price of crude oil and natural gas, industrial production of the OECD, and brick nation performance. Historically, the industry has underperformed the market. Based on future contracts and spot prices, the price of crude oil and natural gas are expected to rise moderately by the end of this year. Optimism can be seen in the decreasing demand to supply ratio on the bottom right. However, there are a few such as the energy consulting firm FGE, which mentioned the persisting oversupply due to an increase in production. Further worrisome factors include the buildup of stock in the US, Nigeria, and Singapore. The global buildup of stock will likely continue through the second half of 2015, while prices may marginally rise. Although some tight oil producers have gone offline, a large increase in prices could easily bring them back into play. Recently, Iranian sanctions have been making headlines. Back in 2012, when sanctions were imposed, Iran exports decreased to almost a third. Having them back on the market could increase supply by around 40 million barrels per day. To the company itself, WPX Energy is based in the United States, where it accesses some of the best resource plays available. Its 2014 end production split was 76% natural gas, 13% crude oil, and 11% NGL. WPX has a market cap of approximately $2.5 billion and enterprise value of $4.5 billion. It trades at a 1.9 revenue and 3.0 EBITDA multiple. Here's an outline of my thesis. WPX spun off from Williams Company in 2012. From June 2012 to 2014, I believe investors were valuing WPX by looking at financial performance. In the light of the recent oil price decline from June 2014 to 2015, investors started looking at WPX purely from a macroeconomic standpoint. Thus, its stock price fluctuated with that of crude oil, thus portraying an inaccurate picture. Management made a smart decision by selling off some of its weaker performing assets to increase its cash flow while focusing on top and bottom line growth. The fact that it has managed to increase revenue as well as margins despite a decline in production shows WPX can operate as more of a sustainable company. Within the E&P industry, companies choose one of two accounting principles: successful efforts or full costs. WPX Energy uses successful efforts accounting, in which it only capitalizes the expenses for acquisition activities that are successful. Considering half of WPX's peers use full cost accounting, which has been acknowledged to produce favorable results for the investment community, WPX is being penalized for using more conservative accounting. As one of WPX's three major basins, the San Juan has been generating many positive results. In 2013, San Juan was ranked as the fourth best U.S. gas field play by the EIA out of its top 100 report. In 2007, there were more than 25,000 gas fields in the United States. WPX also operates in the Williston Basin, which is located in the Bakken. The Bakken has been said to contain more extractable petroleum than any other oil field in the whole country combined. Equity research has gone further to phrase how well positioned WPX is in respect to the Bakken and its expertise in the Rockies Mountain region. Moreover, within the Middle Bakken, WPX is the number one cumulative producer per well. A useful indicator of recovering operating dynamics is the company's bottom line improvement. Looking at percentage change in net income margins, WPX was only one of two companies within its peer group that managed to consecutively increase its bottom line margins from 2013 to 2015. WPX has a large margin of safety. It trades at a 0.6 to its tangible book value and is the second least levered company in its peer group. Less leverage means investors will be able to recover a larger equity portion of the company in the event it goes bankrupt and liquidates. Using the HOLT Valuation tool, it is vital to note the direction of the fade for its economic returns and its recent increase in operating margin. Looking at the warranted upside, it appears as if there has been a recent gap that widened in the past month, providing a good entry point opportunity. Using the HOLT estimator, I assume sales growth, EBITDA margins, and asset turns to be similar in level to those in 2014. HOLT gave a 41 implied upside. Using HOLT's assumptions, an upside of 58% was implied. I think the largest selling point for WPX is its attractive valuation levels. Using oil and gas specific metrics such as EV/EBITDAX, EV/1P reserves, and EV daily production, WPX trades at a discount of approximately 50 to 65% compared to its natural gas E&P pure play competitors. In the event of an acquisition, WPX may see considerable upside. Benchmark pricing was taken from future contracts while hedging effects were excluded to be conservative. Given its current reserves, its crude oil reserves end up tapering off in 2022. Netbacks were projected for $12 for 2015. I sensitized the NAV to WTI and Henry Hub pricing. The NAV valuation came to a final of approximately $17.76 per share, which suggested a 37.5% upside to its current share price. I derived my price target primarily from my NAV. The indicative graph on the left summarizes comparables, which suggests a much higher valuation. When one combines WPX's attractive valuation levels and large margin of safety with its recouping cost structure and asset quality, WPX makes an alluring E&P play from a risk-return perspective. It is likely to survive the low oil price environment and is well positioned to take any advantage of any rebound. With that being said, I'd like to thank you for listening to my presentation today.